At night, Dubai looks untouchable. The towers glow, the roads shine, the malls stay busy long after midnight. From a distance, it feels like a machine that never slows down, never breaks, never admits weakness. That is the image. That is the sale. But look closer, and the picture starts to flicker. A stock exchange shuts for 2 days after regional strikes. Emergency support is offered to businesses in the financial center. Profit at one of Dubai's biggest global operators drops sharply. And behind the polished glass, some of the city's best-known corporate names are not expanding in straight lines at all. They are refinancing, restructuring, renegotiating, delisting, surviving. This is where the story changes, because the real question is not whether every giant is about to collapse tomorrow. The real question is darker than that. In Dubai, what does failure even look like when image matters this much? Does a company close loudly, with empty offices and headlines? Or does it vanish another way? Through trading halts, debt workouts, ownership shifts, court plans, and quiet state-backed rewiring. The uncomfortable truth is that the warning signs do not always look like disaster at first. Sometimes they look like stability. Sometimes they look like growth. And that is exactly why this story matters. Because once you see the pattern, you stop asking which company is next and start asking how many have already been telling us the same story in softer language. Dubai built trust by selling certainty. Not just luxury, certainty. It offered investors a safe hub between East and West. It offered workers jobs. It offered families a clean, efficient city. It offered capital speed, tax advantages, and scale. That promise helped create giants that seemed too central to wobble. DP World became one of the world's largest port operators. Majid Al Futtaim became woven into daily life through malls, retail, leisure, and property. Shuaa Capital sold access to finance. Union Properties sold the future of real estate. Emirates REIT sold income and asset-backed confidence. Amlak sold the idea that structured property finance could survive hard cycles. And for years, the city's biggest names benefited from a simple belief. In Dubai, scale meant protection. Even when trouble appeared, many assumed it would be managed before it became visible. That belief was not irrational. Dubai has repeatedly shown that it can move fast, reorganize, inject confidence, and defend important institutions. But belief systems become dangerous when they turn into blind spots. Because once a city is known for resilience, every warning sign gets reinterpreted as a temporary inconvenience. A debt problem becomes a timing issue. A governance crisis becomes a transition. A delisting becomes a strategic move. A trading halt becomes a technical pause. The language stays calm. The brand stays polished. The stress keeps building underneath. And that is why this topic is bigger than one company. The names may differ, but the sales pitch is the same. This one is too important to fail, too connected to stumble, too visible to disappear. History suggests otherwise. It happened to Abraj. It happened to Arabtech. And once that becomes part of the record, every glossy promise starts sounding a little less permanent. Then the shift begins. Not dramatic at first. That is what makes it dangerous. The skyline still grows. Restaurants still open. Deals are still announced. New firms still arrive. In fact, DIFC said new company registrations rose nearly 40% to 1,525 last year, and the center had 8,844 active firms. On paper, that sounds like momentum. It is momentum. But pressure can rise inside growth stories too. In April 2026, DIFC rolled out temporary support measures for businesses and retailers, including flexible payment plans and grace periods on fees. That is not the language of panic. It is the language of strain being managed before it spills over. Around the same period, the UAE's stock exchanges shut for 2 days after Iranian strikes, a rare step that underscored how quickly external shock can hit the confidence layer beneath a financial hub. This is where the mood changes. The problem is not that Dubai is weak. The problem is that the system is exposed to forces it cannot fully control. Regional conflict, financing costs, global trade uncertainty, capital mobility, and the constant demand to keep growth looking effortless. In that environment, a company does not need to be insolvent to become vulnerable. It only needs tighter cash flow, more expensive debt, thinner margins, weaker investor patience, or a sudden interruption in the story it tells the market. And once that happens, a company can remain open while effectively entering survival mode. The sign is not always a locked door. Sometimes the sign is softer, a delayed plan, a renegotiated facility, A capital reset, a business that is technically alive but no longer moving on its own terms. That is where the numbers start talking. DP World, one of Dubai's flagship global names, reported a 28% drop in annual profit to $591 million, even as revenue rose to $20 billion, with the company flagging an uncertain outlook tied to global trade and geopolitical stress. That matters because giant infrastructure-linked companies are usually treated as barometers of confidence, not just businesses. If a name that large is warning about uncertainty, the signal travels far beyond one balance sheet. Shua Capital is another kind of warning. Its board approved a debt restructuring deal with a senior creditor in late 2024, and by the third quarter of 2025, its filing said the group was still negotiating with a bank to finalize a restructuring agreement while continuing to service the term loan. That is not collapse. But it is also not normal strength. Union Properties shows a similar pattern. The company said its debt restructuring started in the 2022 to 2023 period and renegotiated in 2024 was central to its position, with accumulated losses running into the billions of dirhams. When a property developer is still defining itself through restructuring years later, that tells you the old growth model did not simply bend. It broke and had to be rebuilt. And then there is Emirates REIT, which had to return to bondholders with refinancing proposals for its $400 million sukuk after earlier pushback and a rescinded exchange offer. Again, notice the pattern. None of these stories begins with the word closed. They begin with refinancing, restructuring, negotiation, revised terms. In Dubai's corporate language, those are often the first visible cracks. Not the end, but the moment the illusion of effortless forward motion quietly ends. And this is the part most viewers miss. In Dubai, the system does not always allow weakness to appear in a simple form. Big companies are tied to lenders, developers, landlords, regulators, state-linked entities, and the city's broader investment image. That means the system often absorbs failure by stretching it out. A company does not just fall, it is refinanced, its debt is extended, equity is converted, ownership is changed. A public listing becomes private again. DP World did not disappear when pressure mounted around its valuation and public market fit. It delisted and returned to full state ownership in a deal valuing it at $13.9 billion. That is not a closure story, it is a transformation story. But for outside investors, it still marked the end of one version of the company. The same logic explains why Amlak spent years trapped in restructuring after signing a $2.7 billion debt and financing restructuring deal, and why Shuai's filings talk more like a balance sheet repair manual than a clean growth narrative. In systems like this, incentives matter. Banks prefer orderly workouts to chaotic failure. Authorities prefer continuity to spectacle. Flagship names prefer controlled language to public alarm. And executives know that in a city built on confidence, perception is not a side issue. It is part of the asset base, so the system delays the moment of visible rupture. Useful in the short term, risky in the long term, because when trouble is stretched over years, people stop reacting to it. They normalize it. A company under constant renegotiation starts to look stable simply because it is still there. But survival is not the same as health. Staying open is not the same as being strong. And once you understand that distinction, Dubai's corporate landscape starts looking far less simple than the skyline suggests. Sometimes, though, the mask slips. Drake & Skull is one of the clearest examples. The company later announced that it had completed restructuring requirements and written off more than 4.18 billion dirhams of financial and commercial debt. In 2026, it reported a 47 million dirham profit for 2025, but that came after a 2024 figure that was largely driven by a one-off restructuring gain of 3.79 billion dirhams. Listen carefully to what that means. The headline says, profit. The deeper story says survival after deep financial surgery. Aman, the Dubai Islamic Insurance and Reinsurance Company, gives another signal. Market reports said it pursued restructuring as losses widened, and its shares were halted on the Dubai Bourse in April 2026. A trading halt is not the same as a funeral, but it is the kind of moment that reminds investors how quickly confidence can freeze. Emirates REIT belongs in the same conversation because its refinancing struggle was never really about one sukuk. It was about what happens when asset-backed confidence meets harder money and less patient investors. These are not fringe names in an obscure corner. They are part of a wider story about how Dubai's corporate machine handles stress. Quietly, if possible. Technically, if necessary. Publicly only when it has no choice. And that is why the phrase, going to close, very soon, can be misleading. Closure is often not sudden here. It is procedural, legal, incremental. A series of steps that keeps the facade intact while the underlying company is being redesigned, diluted, suspended, or boxed into a smaller future. By the time the public sees the full picture, the decisive moment may have happened months or even years earlier. The human cost enters the frame when quiet stress becomes hard failure. Arabtech was not a small casualty. It was one of the Gulf's most recognizable construction groups, and Reuters described it as the Middle East's largest contractor when shareholders authorized the board to file for liquidation in 2020. Later, Dubai Financial Market delisted Arabtech, Gulf General Investments, and Marca in compliance with listing rules after those companies entered liquidation processes. These are not abstract corporate events. They hit contractors, suppliers, lenders, employees, and retail investors. Arabtech's collapse also sent shockwaves through lenders, with research cited by Reuters estimating major banks would recover only part of their loan exposure. Then there is Abraj, once the largest buyout fund in the Middle East and North Africa. It collapsed after investor concerns over the management of its $1 billion healthcare fund, and the fallout was so significant that Dubai later issued a new insolvency law for DIFC after the collapse. That is the part people rarely say out loud. Big corporate failures do not just damage balance sheets, they force legal change. They alter how the city governs risk. They leave permanent marks on trust. And trust is the invisible infrastructure behind every sale, lease, bond issue, and investment roadshow. When viewers hear Dubai Company, many still imagine certainty. Yet Arabtech and Abraj proved something else. A large name can be celebrated for years, central to the narrative, and still fail in a way that changes the rules around it. Once that truth enters the record, every restructuring story becomes more loaded, because now investors are not just asking whether a company can refinance. They are asking whether they are watching the early stages of another name crossing the line from strain into irreversible decline. There are deeper layers here, and this is where the story stops being about 10 names and starts becoming about the environment around them. First, financing is more expensive, and patience is thinner than it was in the easy money years. That alone changes what counts as a manageable debt load. Second, Dubai's growth model is still heavily linked to construction, property, trade, and sentiment. Reuters reported that major UAE developers are increasingly bringing construction in-house to control costs, timelines, and profit capture. That may strengthen developers. It can also squeeze independent contractors, especially after a period in which contractors were already exposed by failures like Arabtech. Third, family business governance is becoming more visible as a risk factor. In 2025, Dubai intervened in the board structure of Majid Al Futtaim through a special judicial committee to stabilize governance after succession tensions, even though the company said operating businesses remained independently overseen. That move was not a closure signal. It was something more revealing. It showed that in one of the Emirates' most important conglomerates, governance itself had become a public economic issue. Add regional conflict to the mix, and the picture gets sharper. Market shutdowns, emergency support packages, and safety-driven corporate contingency planning all remind firms that location advantage can be tested fast. Put all that together and the hidden truth becomes clearer. Some companies are not in danger because they are badly run in a simple sense. They are in danger because they are operating inside a system where debt, governance, global volatility, and perception are all tightly connected. One weak point can be managed. Several at once become something else. They become a pattern. And that pattern is not unique to Dubai. That is what makes it so important. Every global hub tells the same story in its own accent. In Hong Kong, London, New York, Singapore, or Dubai, the most visible firms are often treated like symbols of the city itself. That gives them advantages, easier access, more patience, better narratives. But it also creates denial. People assume prestige can outrun structure. It cannot. When rates rise, trade slows, conflict spreads, family control becomes contested, or investors start demanding harder evidence instead of softer storytelling, the same cycle appears everywhere. First comes the insistence that nothing is wrong. Then comes temporary pressure. Then strategic review. Then refinancing. Then, restructuring. Then, a new owner, a new board, a suspended share, a delisting, or a liquidation. Dubai's version is distinctive because the city has been extraordinarily good at maintaining momentum and attracting fresh capital, even while pressure builds beneath the surface. Reuters reported that DIFC registration surged. At the same time, Reuters also reported emergency relief for businesses in the center and a rare market shutdown after regional attacks. That contradiction is the story. Growth and fragility can exist at the same time. A city can be expanding and exposed. A company can be profitable and pressured. A balance sheet can be alive and still be warning you. So when people ask which 10 Dubai companies are going to close soon, they may be asking the wrong question. The sharper question is this: which companies are still being treated as secure because they look important, even though the mechanics underneath them have already changed? That is usually where the real story begins. Not at the end. At the moment the public narrative and the private strain stop matching. So what is the uncomfortable realization after all of this? It is not that Dubai is collapsing. The evidence does not support that. It is something more precise, and maybe more unsettling. In Dubai, some of the biggest corporate risks are hidden by the city's greatest strength: its ability to project confidence while buying time. That can stabilize markets. It can also blur warning signs. DP World's profit pressure, Shua's creditor negotiations, Union Properties' long restructuring arc, Emirates' REIT's refinancing fight, Drake and Skull's debt write-off after deep distress, Amman's halt and restructuring signals, Amlak's years of repair, Arabtech's liquidation, Abraj's collapse, Majid Al Futtaim's governance intervention. These are not all the same story, and they are not all about imminent closure. But together, they reveal a system where corporate trouble often arrives in stages, behind controlled language, long before the public is ready to call it danger. And that is why this matters to anyone watching Dubai from the outside. Because the next major corporate failure, if it comes, may not begin with panic. It may begin with the same words we have already heard so many times: review, support, restructuring, extension, reorganization, calm words, technical words. Words that sound safe until suddenly they are not. So here is the question that stays after the credits roll. In a city built on ambition, speed, and image, how do you tell the difference between resilience and delay? Between a company that is adapting and a company that is being slowly prepared for a softer kind of ending? Tell me which Dubai company you think looks strongest on the surface but most exposed underneath. And if you want more investigations like this, stay close. Because the next warning sign rarely arrives with a siren. It usually arrives with a press release.